None other than Mr. Anand Gopalakrishnan, former whole-time director with SEBI, joining in to discuss what could the budget entail for capital markets in particular. Anand, great to have you in ET now. Tell me, what are your budget expectations, especially when it comes to securities or capital markets? Any securities transaction tax? Anything on that?
I think when it comes to taxation, there are a couple of issues that I would like to see addressed over a period of time. It doesn't necessarily have to do with what's happening in the market right now. The first relates to one irritation which is felt by foreign investors, both FDI as well as FPI, in that we are one of the few outlier countries that applies a source-based taxation principle on them. Practically every major market, including the US, etc., they apply the OECD recommended model of destination or residence-based taxation, which means if you and I invest in the US, any capital gains that we accrue in US securities, we don't have to pay tax in the US. We only have to pay in our home country, i.e. India. On the other hand, when foreigners come into India, we apply withholding tax on the capital gains. Of course, we have tax treaties, but nevertheless, it's a major irritant for foreign investors because A, we are an aberration. B, if the investor themselves are exempt from paying any capital gains tax in their home country, this withholding that they pay in India, they can't set off and is therefore a drag. Second, even if they are paying capital gains tax in their home country, some of them struggle to get a set off against the withholding that has been done in India, because the nature of our withholding is not amenable to getting tax credits. And finally, remember, we calculate capital gains in rupee terms. At a time when rupee is depreciating, that again becomes a big drag for foreign investors. So I think it's important that we address this in the medium term. You know, the recent judgment of Tiger Global was in the Supreme Court also doesn't help in terms of giving the overall picture on and clarity, legal clarity around taxation. It would be best if we went to the global best standards of moving to a destination-based taxation and therefore not apply withholding tax on capital gains enjoyed by foreigners in India. This would be, I think, one big move that I would like to see happening at some stage, if not in this budget, at least in the future.
Right. So how could the government sort of calibrate a tax regime that boosts the private sector's role as a partner in capital formation?
The point I made about moving towards a residence-based taxation for foreigners, I think would be one step in the right direction. The second thing that I think we could do is, even on the domestic front, there are some aberrations. So what happens currently is, because the headline optical, long-term capital gains tax on equity is lower compared to, let's say, investments into corporate bonds or into InvITs or into REITs, tax becomes a big determinant of how much of our personal savings we put into which asset class. Now, frankly, tax should not be a determinant. Based on our risk appetite, we should be doing an asset allocation across equity, across debt, across commodities, across all asset classes. And tax should not be the determining factor. Now, because optically it looks like for equity it's the lowest, you could argue that a lot of the flows that are going into equity markets, and there's been this dramatic rise in both the number of investors from domestic front, as well as the size of their money going into equity markets, has seen a sharp rise over the last few years. Now, because of this, you could argue that there are pockets of overvaluation, which, in a funny way, makes it easier for foreigners who have invested, even in good companies, to exit because the valuations look pretty attractive. And on the contrary, the incentive for a good company to invest more also comes down because they're getting valuations which look pretty rich anyway without taking adequate risk. So having an asset agnostic, uniform and low LTCG tax regime across investment classes, or at least moving towards that, might help a proper asset allocation by domestic investors across asset classes based on their risk appetite. It would ensure that money goes into the right asset classes entirely based on those markets and risk appetite rather than tax, and therefore allow for more deeper and sustained capital formation. So I think these two things, one is exempting foreigners from onshore capital gains tax because they will be taxed in their home country as per their home country regulations, and ensuring that we have an asset agnostic uniform taxation principle across assets for domestic tax and keep it low. Don't keep it high because that would be going against capital formation. Both of these should help us in grow our capital markets in a sustained fashion.
Hi Anand, how can India improve its net inflow of FDI, especially into some of the key new sectors like AI, semiconductor, and electronics?
We've got to make sure we remain an attractive destination for that capital to come in. Now, as the economic survey points out, our gross FDI is looking pretty good, but we are seeing a lot of repatriation, and we are also seeing outward FDI, which means while we are attracting capital, we are not giving it enough reasons to stay. Now, to ensure, there are lots of reasons that go into the choice of where capital flows. There is things like ease of doing business, local regulations, and how much we make it easy for people to invest. The reforms on labor laws are also going to be useful. But I do think taxation has a role to play as well. As I mentioned earlier, making sure that we are not taxing capital in a very unique manner, in a kind of an outlier model, as we are doing currently with all of this source-based taxation in India withholding, that will ensure that all the other positives that we have in terms of being a high growth country with an immense economic potential, with a lot of vibrancy in reforms, etc., all that will stand out. And this irritant that's there in terms of tax will go away. The other thing which, paradoxically, I think we should allow, it's not a bad idea to allow some of our Indian savings to move abroad as well. Now, it sounds silly because how do you allow outflows at a time when currency is under pressure? But I would argue that a lot of the money flowing into equity markets and arguably causing overvaluation there is because we are not making it easy for our domestic investors to actually invest overseas and therefore ensure our capital markets remain efficient. So if we were to increase the limits available to mutual funds to invest overseas, currently it's capped at $7 billion. If we were to gradually increase by, let's say, $1 billion every month, that would ensure that global capital markets also remain open for our savings and thereby ensure that there is some kind of efficiency in our capital markets vis-a-vis the global markets.
Anand, you have advocated a residence-based regime for withholding compared to the source-based taxation. How will this make foreign investments into India more attractive?
As I mentioned, currently we are an outlier because we are one of the very, very few countries that applies this, source-based taxation principle. Which means imagine that you're a global sovereign wealth fund or a global regulated mutual fund or a trust registered in the US or in Europe or anywhere. You have to keep aside a separate process only for India taxation, where you have to calculate what are your capital gains. You have to see what the treaty says between your country and India. You have to have a withholding tax regime. If you can get a set off against your local taxes, you have to apply for that. And all the issues that I mentioned about if you're actually tax exempt in your home country, or if you can't get a set off, and remember, we are calculating gains in rupee terms, which is not the currency that the foreign investor is looking at. All these become drags and issues as far as the global investor is concerned. So, by the way, there is the sense that if we move to a destination or a residence-based taxation regime, it would be giving exemptions to foreigners at a time when we are taxing domestic. We are not actually, in the global context, we are not giving an exemption. They would be liable to pay whatever capital gains tax is liable in their home country. Similar to what happens today, if you as an Indian invest in US or in Europe, you do not have to pay capital gains in the US for equity markets. You only have to pay your capital gains in India. So it's only going to the global best practice. You're not giving any exemptions to anybody. If at all they're paying a lower capital gains tax, it's because their home country LTCG regime is different from ours. And that's a different debate to have. So what I'm advocating is simply moving to parity as far as the global best practices are concerned. that alone, and I'm not saying that's the only reason, but that alone should be a big relief in terms of removing an irritant for global participants currently.
Right. Anand, such a pleasure having you on the show today. Thanks for that insight.